and welcome to this video on coin supply appraisal, the second step in cryptocurrency fundamental analysis. So analyzing and understanding the potential price and value of a cryptocurrency can be both tricky and frustrating. There's no quick and dirty methods of analysis that can forecast a coin's price, but there's still some parameters that can help you understand where it might go and how to gauge if the coin is still a good potential investment. Developing a good understanding of these factors can help you understand some of the things that are going on in the market. Nobody can know everything that's happening in the market, but understanding these concepts will enable you to know a few things, because some understanding of the market is always better than no understanding. The cryptocurrency analysis concepts that every coin investor should be familiar with are total supply, circulating supply, coin price, and market capitalization. Researching these topics will give you a better, but not always clearer, understanding of what's happening with the market. So what you're going to want to do is pull up your list and go through each one of the coins you wrote down in the reconnaissance section. What we're looking to do in this step is do some basic research so we understand the economic potential of each coin, what the current economics are, and some other good information we should know. So the website we're going to use is coinmarketcap.com. We covered it in the reconnaissance section, and now we're covering it in this section as well because it's an extremely popular site in the cryptocurrency community because it's one of the best ways to get information on a coin as fast as possible. So pull up the website and look at any coin you want. I suggest looking at a coin like NEO as an example. If you've never seen this page before, it might be somewhat confusing at first, but it's worth getting very familiar with it. Let's start by breaking down the different metrics we have here. One of the most important to start with is the total supply of the cryptocurrency. The total supply, also known as the fully distributed market cap of a cryptocurrency, is the number of issued or minted coins of that specific currency currently in existence. This number will include both the circulating supply, which we'll get to in a second, and those that are locked up for a number of reasons. Those locked coins are usually being held up by the team, private investors, and bounty accounts in a public account that will be released over time. Really, there's a number of reasons why these coins are not available to the public. The total supply is important because the size of it can determine the coin price. A popular rule of thumb is that the larger the supply, the lower the price. But this is not always true because of outside factors, such as investor sentiment and legal restrictions, which can also affect the coin price. Three factors which can really shape the total supply are the founders' coins, the mining rate, also known as the coin inflation, and the company lockup. Some coins are also taken out of the total supply for bounties and promotion as well, but that's dependent on the coin we're looking at. Knowing what these three terms mean, the founders coins, the mining rate, and the company lockup, is important because they can provide more data for analysis. Let's start with founders coins. It refers to the coins that the team behind an ICO or an established coin keep for themselves. These coins might be sold off after a period of years or kept by the founders as personal nest eggs. You can usually learn about the number of founders coins by carefully reading the project website or white paper. The amount of currency reserved for the founders is usually listed there. We'll get to those in later videos. Many cryptocurrencies have a founder coin allocation between 5 and 30%, with 10 to 15% as the usual figures, though there are some cryptos where the founders own most of the supply. Generally, the less coins a founder holds, the better. This is something that's very different from how companies are run in, say, the stock market, where generally public stockholders are allocated a tiny minority of the stock in the company. In crypto, it's not unusual to see a project with 50 to 75% of the total supply allocated to the public. Some projects even go to 100%, which usually means they're an open source project like Bitcoin or Vertcoin, and that's a great thing to see. Another good point, that again we'll cover when we discuss the white paper, is that a good project will have founder coins locked up from 1 to 4 years, and then release them on some automated distributed smart contract to prevent the founders from dumping their coins on the market all at once. This protects the investors and the coin value, though if the investors learn the founders are dumping their coins, that's usually a bad sign and will drop the price as a result. The mining rate is the speed at which new coins are created or minted from the blockchain. It can affect the supply because the faster mining means more cryptocurrency on the market, which can lead to a lower price. Determining the total mining rate for a cryptocurrency can be tough because different miners have different speeds. This rate can be established by tracking the rate of change in the circulating supply, and there's plenty of good sites for tracking this information, such as blockchain.info or bitinfocharts.com. This is something that Bitcoin really nailed because the mining reward is halved every 4 years, meaning Bitcoin is deflationary by design. This means that the amount of new Bitcoin created and earned by miners with every new block of transactions is cut in half. This is part of Bitcoin's predictable, transparent monetary policy, which can be verified in the source code available on the Bitcoin Core GitHub repository. As less Bitcoin is being rewarded and thus introduced into the circulating supply, in fact, 3 out of every 4 Bitcoins that will ever exist have already been mined, then there's less Bitcoins to go around, especially as people hoard them or some are inevitably lost. So the increase in supply is far outpaced by the increase in demand, leading to an explosion of price as we've seen. If mining power had remained constant since the first Bitcoin was mined, the last Bitcoin will be mined during the year 2140. But obviously over time, more mining power will be introduced to the network, so that will come down. Essentially, in a centralized economy, currency is issued by a central bank at a rate that is supposed to match the growth of the amount of goods that are exchanged, so those goods can be traded with stable prices. The monetary base is controlled by a central bank. In the United States, the Fed increases the monetary base by issuing currency, increasing the amount banks have on reserve or by a process called quantitative easing. However, in a fully decentralized monetary system, there's no central authority that regulates the monetary base. Instead, currency is created by the nodes of a peer-to-peer network. The Bitcoin generation algorithm defines in advance how currency will be created and at what rate. Any currency that is generated by a malicious user that does not follow the rules will be rejected by the network and is thus worthless. So mining rate is extremely important to know, but we'll discuss it more when we look at the white paper because we won't be able to determine if the coin we're looking at uses mining until then, especially if the coin doesn't use mining. So the last piece to consider with total supply is the company lockup, and it's the number of coins deliberately kept off the market by the team behind a project. Unlike the founders' coins, these coins are held by the project rather than by individuals themselves. Like the founders' coins, the end of the company lockup can suddenly change the circulating supply by releasing a large amount of coins onto the market. The amount of company lockup is usually revealed somewhere in the coin's website or white paper. So total supply is very good to know because it gives you a perspective as to how many coins are in existence for the cryptocurrency you're looking at. It gives you a sense of any possible inflation if there's a big difference between the total supply and the circulating supply. The total supply must not be confused with the maximum supply or max supply. Some cryptocurrencies, such as Bitcoin, are designed with a limit on the number of coins that can be mined. Once maximum supply is reached, there will be no new Bitcoins, which as I said, is probably going to happen in 2140. Other coins, like Ethereum, have no maximum supply, so their total supply can keep growing forever. And still others, like Neo, have both a total supply and a maximum supply to indicate that there's a max on the total supply of this cryptocurrency, and the total represents how many total coins have been issued. In the case of Neo, the total supply is equivalent to the maximum supply, meaning that every Neo coin that will ever be minted has already been created. We know this by reading Neo's white paper. That process requires that every coin that will ever be created for Neo already exists. They also indicate in the white paper how some of the coins are not in the circulating supply, but locked up from access by the team and will only unlock after a certain period of time, at which point the team can choose to introduce them to the circulating supply and inflate it, or intentionally keep them locked up to let the price of the coin increase as demand increases. Alright, so we've mentioned circulating supply enough that we should talk about it. The circulating supply is the number of coin for sale or potentially for sale in the market right now. This number can easily be determined by looking at any coin's page on CoinMarketCap, which will list the circulating supply. Now, circulating supply directly affects the price of the coin. The lower the circulating supply, generally the higher the price. However, that is dependent on the market cap, which we'll talk about more in a bit. The circulating supply is what's used to calculate the price of the coin, not the total supply. Now, people ask, if that's the case, doesn't that mean the founders' coins and the company coins are worthless? Not quite. It means that you could essentially value them the same as coins in circulation, but introducing them would increase the circulating supply, which in turn would cause the price to go down, as price is calculated by dividing the market cap by the current circulating supply. This means that a cryptocurrency with lower circulating supply such as 10 million coins, is going to have a much higher price per coin than a coin with a higher circulating supply of, say, 100 million. For example, Ripple, with billions of coins in supply and with a market cap in billions, has a coin price that has only ever been less than $1 or a couple dollars, depending on when you've been looking at it. Ripple, due to its huge coin supply, will likely never have a coin price that is $50 per coin or $100 per coin, at least not for a very long time. Small circulating supplies allow for higher prices per coin to be reached, assuming the same market cap. Another point here is that a coin with a small circulating supply is likely to rapidly increase in price much faster than a coin with a large circulating supply. For example, it's much easier and faster for a coin like Monaco with 13 million circulating supply to reach $25 per coin than a coin like 10x, which has a circulating supply of 104 million. The price jump tends to be quicker. Generally, changes in circulating supply precede a price change. Usually, a bigger circulating supply indicates a lower price, and a smaller circulating supply leads to a higher price. Remember that a change in circulating supply occurs when new coins are mined, or some of the coins in lockup, such as founders' coins, company coins, etc., are released into circulation. So we've now covered the three metrics of supply: circulating supply, total supply, and maximum supply. Remember, all coins will have a circulating supply, except those who haven't yet had their ICO, meaning coins who haven't been given to the public yet. So now that we've covered supply, let's talk about price, the manifestation of demand. The coin price is the amount that a unit of a particular cryptocurrency is selling at in the market right now. This is the number that news stories about a particular coin will usually focus on because it's easy to understand. A headline saying that Bitcoin is $10,000 is referring to Bitcoin's coin price. As we mentioned, the coin price is determined by a combination of market demand and circulating supply. Note that I said determined, not calculated. You calculate coin price by dividing market cap by circulating supply, but you determine coin price by the combination of market demand and circulating supply. Remember, circulating supply is the total amount of coins in circulation right now. This does not include the coins that have not been released yet. The size of the circulating supply will affect how fast the coin can change in price. A sudden increase in the circulating supply, such as the coin founders releasing their held coins into the circulating supply, can lead to a dramatic change in the coin price in a downward direction. But again, this is rare and usually does not happen so dramatically. The second piece to consider is market demand. Market demand is a simple concept to understand, but a hard one to measure. A high market demand will usually lead to a high price if there's a limited circulating supply. Market demand is simply this: how much people are willing to pay for a coin. The higher the demand, the higher the price. A low market demand will often lower the price. Something to remember is that a lower price will not always lead to a higher market demand. Market demand is hard to measure because it's often affected by outside forces that are hard to measure, such as investor sentiments and news coverage and upcoming announcements. Market demand and thus coin price often go up after positive news stories or announcements from the team or partnership reveals. But the thing is, and Doc is very adamant on this given his decades of watching markets, by the time something is announced, it's often already been priced in. Another thing we often see is the repeated example of buy the rumor, sell the news. Even if a project announces a huge new feature or partnership, there will be someone willing to sell during that announcement. So let's now consider the psychology of coin price. When looking at a coin price, there's something to be said about the psychological factors that play a role. A cryptocurrency that hits $1, for example, passes a sort of psychological milestone. We could say the same thing about Bitcoin when it hits $1,000 or $10,000 or $20,000. A coin passing a certain price seems to spike serious market demand as the coin proves its value. The takeaway is that if a cryptocurrency climbs past a certain price, that price becomes fixed in the minds of the public. For example, a cryptocurrency that was once a couple cents, rising to $1, and staying at $1 for a period of time will likely have people fixing on that $1 value as the worth of that cryptocurrency. Another thing we see is that coins with higher circulating supplies, and thus lower prices, are misconstrued as being cheaper. There is a misguided sense that if you have two coins with the exact same market cap, meaning they're worth exactly the same as far as the market is concerned, but with one coin, you could get 1,000 coins for $1 each because that's the price of the coin. Whereas with the second coin, you can only get 100 coins because they're $10 a coin. Then some people feel like the first coin is the better option because you can get more of them, even though I have to stress their value is exactly the same. We see this all the time with Ripple versus Bitcoin. Ripple's circulating supply is 39 billion coins, whereas Bitcoin's is only 16 million. So of course, people see Bitcoin's coin price at thousands of dollars for a single Bitcoin, and then they see Ripple as less than $1 or a few dollars, and they think, what a steal. I can get thousands of Ripple coins for the same price as only one Bitcoin. Another thing we see happen is with new coins entering the market after their ICO. The more investors there are holding a huge supply of coins they bought for cheap during an ICO, the harder it may be for the coin price to go up without a serious correction happening. The number of investors who bought in at the ICO price often need to be washed out of the coin before the coin price can really go up. These washouts happen when there's a correction and the people who bought the coin in the ICO sell out of their coin and take profits. This is known as flipping. So it's not a good idea to buy a coin right out of an ICO without first waiting for a big correction that washes out the early investors. Okay, so let's finally discuss one of the most important, if not the most important factors of investing and what you really need to pay attention to. Market cap, or market capitalization, is the most important number related to a cryptocurrency. You should study market cap carefully because it's the easiest factor related to a coin to measure and understand. The market cap is the value of all the units of a coin on the market right now. It can easily be determined by simply multiplying the circulating supply by the coin price. The market cap is vital because it determines how much potential ROI, or return on investment, you can achieve. A high market capitalization means there's less room for the coin price to increase. A low market cap indicates that a coin might be capable of more growth. Knowing the amount of potential price growth is good because it can determine the potential ROI for a cryptocurrency. The ROI is always a good thing to know because it's the amount of money you might make from an investment. Some investors use market cap for bargain hunting. They look for good ICOs or coins with a lot of potential value and low market capitalizations. This, plus the characteristics we're looking for through fundamental analysis, can be a sign of a good cryptocurrency that the market is ignoring or has not yet discovered. Generally, we classify anything above a $1 billion market cap as a high cap, which is around the top 25 or so. Anything below a $1 billion market cap, but above 100 million, is a mid cap, which generally covers the top 100 or so. Anything below 100 million, but above 25 million, is a low cap, generally within the top 100 to top 200. And anything under 25 million is a micro cap. But there's no need to follow our model. We just think these are the natural groups that coins can fall into based solely on market cap. For example, I think you need to value a mid cap very differently than a micro cap. A mid cap will be much more established, it will have a bigger community, and information will be much more accessible. A micro cap will be much harder to evaluate because the information is not going to be as accessible. This, of course, makes it a riskier investment on the basis of lacking information alone, but also because a micro cap is much more likely to fail than a mid cap or a low cap. That being said, you also have much more potential ROI, likely a double-digit multiplier if a micro cap goes to a low cap or a mid cap category. And if a micro cap goes to the high cap category, start thinking about which beach you want to retire to. In all seriousness, I think looking at market cap is extremely important for understanding the inherent risk this asset has without even looking into it at all. Combined with knowing the current price, the circulating and total supplies, where it's trading, the price history, generally is enough for me to have a good first impression whether or not I want to consider moving forward with my research on a coin. On average, 10 seconds is all I'll need to look at a coin's coin market cap page to know if I want to invest or not. Some things I look for are first determining what market cap category it belongs to so I know how to treat it. I'm going to be much more skeptical of a microcap than a midcap, for example. I look at the circulating supply and the total supply, and now this is completely subjective, but I like projects with a circulating supply of less than, say, 100 million coins. This gives them a fairly solid, predictable price to supply growth, but that's just me. Some people prefer coins that have 1 billion coins or more because they like the low price to high coin count feeling. Some prefer coins with very low supplies, such as 1 million and below, because those become very expensive per coin. It's up to you, and as I mentioned, there are market psychological factors and strategies surrounding them that you need to consider. Another thing to weigh is if a coin has a circulating supply of, say, 5 million, but the total supply is 100 million. Now, this could mean that there's a lot of mining rewards to gain, but it could also mean that the project team has kept a lot for themselves, and this is generally not looked upon favorably. For example, some people are heavily critical of Ripple, as the team has a very large amount of the total supply. One other thing we want to consider is behavioral and value investing with market cap. Value and behavioral investors pay a lot of attention to market cap because it can give an indication of investors' attitudes towards a particular cryptocurrency. A high market capitalization can indicate investors like a coin and are willing to pay more for it, and that particular cryptocurrency has a lot trading on it. A lower market cap might reveal a cryptocurrency that investors do not want at any price. Of course, this depends completely on the market sentiment at the time. Such reading of market cap can help investors pick up future bargains. A low market cap might indicate that investors do not understand the potential value of the technology involved in a project, for example. A high market capitalization for another project might indicate that investors are overestimating the potential of that coin or just buying the coin out of FOMO or fear of missing out. There's also very irrational factors that may inflate market caps. Understanding such behavioral factors can help you make better use of market cap in your analysis. And so, in summary, this is why more research is always better. Market cap, total supply, circulating supply, and coin price are only the beginning of what you need to know about a cryptocurrency. There are many other factors that can affect its price. Other factors can include technology, marketing, investor psychology, economics, politics, regulation, reputation, crime, market hysteria, the news media, forks, rumors, plans, and market sentiment, just to name a few. You cannot discover or predict everything, but it is possible to learn a lot through the research you're about to do. So now that we have a better sense of the economics behind our coins, we need to do our homework. Now that you've performed a basic coin supply analysis, we now need as much research about the coin as we can. One of the first things to do is read or listen to everything about the cryptocurrency, even the pieces with conclusions you do not agree with. The more you know about a cryptocurrency, the better. It's what you don't know that will cost you money in the market. In the next video, we're going to start by seeing what other people are saying about the coin, which I refer to as the evaluation of evaluations.